Hello traders, Gary Wagner here. It is approximately 10:50 a.m. in Honolulu, Hawaii, Monday the 8th day of August, and this is the daily report for gold. What an incredible day we are witnessing. Major sell-off, down about 6%, 500 plus points in the S&P. And gold beginning yesterday, we had this gap up of about $30. We're looking at just a daily chart. You can see this gap up where it closed 1660. Here's the open, and it hasn't looked back since. Currently trading anywhere between 1717, 1720, up about $70 on the day. Of course, I was waiting for some sort of a dip in the market. We didn't see it. We did recommend buying yesterday. Traders that got in, you're in around 1686 on this last trade. I'm glad that we're in. We're going to look to position another portion of that, allocate that to add to the position. This, of course, will be another extended report as there is a lot to cover all here on today's daily report. First thing I want to do, Henkin Candles, daily chart. You wouldn't expect anything different, but look at the length of this body. Look at the length of this tail. Of course, no lower tail. Absolute breakout above and beyond any expectation. And that takes me to our weekly chart, because when we look at our weekly chart, as you know, in most typical markets, what you witness is on a channel, meaning it will tend to trade to the highs and then to the lows of these bands. We can see that in this particular case, you had this utter breakout above this band. That's extremely significant. We noticed that last week as it came up to, but traded a little bit over. I was a little bit hesitant because typically, as you can see, you will typically get the market trading within these channels. However, they do break out. When they break out, of course, the bands go higher, the ranges go higher, but when they break out, they're significant. The other significant thing to notice on this weekly, you'll notice it on a daily for the first time, you've got a real gap in the marketplace. If you look throughout history, you get very few gaps. And now here you've got the tail in there, so it's not a true gap. But when I look at the activity on a weekly chart from 2008 up till present in the cash market, this is the first gap we have seen in what? 3-4 years. Incredible action in the marketplace today. Now, traders, the next chart I want to take a look at, it's going to be a short-term chart, 15-minute candlestick chart. Reason for us looking at this morning is to show you the open in Australia yesterday. Of course, this is 8-7. This is going to be what we call Sunday's activity here in the States, also in Hawaii. Monday in Australia, and then of course the follow-through for today right in here, and as we can see, these new highs right here. So let's get right to the board. As you can see, this market trades in a tight range, but on the open, this is that gap. This is the first real gap we have seen. Of course, in a continuous market such as a spot market, the only day it does not trade is Saturday. So that one of the reasons we have never seen, or I should say have not seen a gap since 2008 and before, is because it can only happen during one day in this 24-hour market, and that is when the market closes on Friday in New York and then reopens Sunday, which is Monday, of course, in Australia. Here's that gap. And you can see this market has been pretty much a runaway train. Market opens up, it retraces ever so slightly. This is where I issued the buy signal, is when I saw that small dip. I realized that we had to position ourselves somewhere. Market took off and running, hits a high right around 1715, finds support because it comes down to a low. I believe it was about 1702, came back up 1710, comes back and breaks below 1700 for the slightest period of time. Here you see around 1693, and of course here we've got the market trading this double top here, 1790, so call it 1718. That is the bid. The ask, of course, is $1 higher, so you're looking at roughly 1720 gold. You heard it right. This market is absolutely on fire. Now, of course, this is being attributed to, I should say, a downgrading from our AAA rating to a AAA rating, but not a plus AAA rating with the Standard & Poor's. But I don't think that that's the real issue. The real issue, and this is what the Chinese credit agency pointed out last week, this is what Standard & Poor's talked about today, it is the inability for the U.S. government to solve its problems. These are solvable issues that need serious men debating the issues and coming up with some concrete solutions. Rather, you have chicken fights, you have a scenario in which there is such a dichotomy, there is such a split within the House, the Congress and the Senate right now as to what to do with this. On one hand, you have a Democratic Party that is looking not to cut entitlements, and on the other hand, you have a Tea Party that is saying they're not going to raise taxes. They're both drawing lines in the sand, and the problem, the issue, the real issue, traders, is the fact that these lines in the sand are so far apart that no one is budging. And as long as those lines remain the same, there cannot be a solution. And that's the real issue. We see a real impasse here within the market, and that's what's causing this incredible downgrading of our belief right now, our belief that we could in fact be witnessing something more severe than we have seen in a long time. If you look right now, this daily candle on the Henkin is a straight open and close. It's opened on the low comparing to the day before, and it's trading on a new high of the day. Incredible. Traders, let's go to some of our forecasts, because I think that what now is very, very critical is where is this market going to go? And to do that, you know that on Friday I started putting in a couple of numbers. You know that one of my critical numbers was right around the 1708 area, 1703 to 1708. That's that band, and what that band is, and we talked about this last week, and my God, what's so interesting is when the market was trading down at 1650 and I was calling the 1708, I got letters that said, do you really think that's possible to happen so quickly? You can now see that the move in wave 1, wave 2, wave 3 is now equal to and above that of the first wave on our Elliott wave count. What does that mean? Typically, wave 3 is the biggest of all of the impulse waves, except in commodities. There you can get wave 5 being the all-around biggest. We can look at that historically, but we're not going to have time for that today. So what do you start to look at? Well, really, you can get anywhere between a 100 on the low side to a 1.61 times that of wave 1 is very realistic on a really bullish wave. And therefore, what I've done is I've put up this upper mark right here. This upper mark is 161% times that of wave 1. It takes us to 1778, call it 1780. My new target, and this has been a target I've talked about before, and this is where it comes from, is 1780 to 1803. Somewhere in that area is what I am now looking for the conclusion of wave 3. We still have a correction of wave 4, and then we have a final wave 5. So, traders, where am I looking at? Historically, we could see mid-1850s. My initial target was around 1800 through the end of the year. That's got to be pushed up. That's got to be adjusted at this point because my sentiment is so strong in terms of the bullish side of gold. One last chart before we go, traders, and this is going to be another, that was a 360. This is a daily chart, and this is going to show you a couple of different vantage points. Well, initially, I looked at the possibility of the market going to one area, but as you can see, it has found this one top right here, which is 176 extension from the first wave 1, which if you take a look, traders, let me try to pull that up for you. It was some time ago, but that's counting it back from here. In other words, what I was looking at was this initial rally. If we take this particular move that we saw, we project it starting from here and we go 176%, you get to this one point. That's a 100% move. Excuse me, I am incorrect. I'm reading my charts wrong. That's a 100% move. It's equal to the move that we have seen here, is now equal to the same move. So the rally itself now has gone almost to the same point as the first part of this rally. You have to excuse me. This is one of those days that are extraordinary, and as us as analysts try to assemble the data and to put it into perspective, it's sometimes a little difficult. A lot easier for me. I've been bullish on gold for years now, and I've been looking at these numbers now coming into fruition right now. Traders, we're seeing some incredible moves in the market. I think they're going to continue. What am I looking at the top end? Well, you can see it right here, and this is where I pulled out that 1803 to 1807. That is this particular band, this Fibonacci extension. We'll go into more detail about that band later on this week. This has been a special edition of the Gold Forecast. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange